Welcome back, my friends. As you may have noticed, we are seeing many experts making many assessments and predictions about the economy. Speculative investments are having a disastrous year. Cryptocurrency companies are going bankrupt. Risk assets have been losing value at least since January. The benchmark S&P 500 is down almost 20% this year. Many stocks, tech and real estate-related stocks, are down anywhere from 30% to 97%. A wave of layoffs is sweeping the United States. The layoffs are more concentrated in technology companies, but retail and shipping are not immune. Many real estate YouTubers are saying all sorts of things about the housing market. House prices are definitely going down. And overall real estate sales are declining each month. As we all know, inflation continues to rage in many countries. And the Federal Reserve is aggressively raising interest rates. That is raising the cost of borrowing. And many big purchases rely on borrowing. So, business for house and car purchases is in decline. There seems to be some debate about what is really going on. And today, another shoe has dropped. Business travel has flat-lined. United Airlines CEO Scott Kirby said, business travel demand has plateaued. Revenue continues to rise thanks to strong demand and capacity constraints, he said. Kirby said the carrier isn't seeing a recession in its data but I am forecast a recession induced by the Fed, Kirby continued. Is this just a correction, a recession, or is it a collapse? Or is it a slow-motion train wreck in which prices keep slowly trending downward for a long time? What does this mean for the future of the economy? And what does it mean for the future of the United States? But before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Business travel demand has plateaued, United Airlines CEO Scott Kirby said on Tuesday. Major companies, many in tech, have announced plans to cut back on spending, like business travel or even lay off workers. United Airlines has several major hubs: San Francisco, Newark, Houston, Washington, D.C., and Chicago. It feels like business travel has plateaued, said United Airlines CEO Scott Kirby. And this probably is indicative of pre-recessionary kind of behavior, Kirby continued. So far, we are not yet seeing a recession, Kirby continued. But we are forecasting a recession induced by the Fed, Kirby noted. If I didn't watch all of the financial shows, the word recession wouldn't be in my vocabulary, just looking at our data, Kirby said. United reported a profit in their Q3 earnings call in October. And, more importantly, they guided to another profit for the last 3 months of the year. Management cited a few important factors: continued strong demand, a lack of available aircraft, and a shortage of trained pilots. If you have flown recently, you already know that these factors have driven up airfares. And this has returned the nation's largest airlines to profitability. Kirby also pointed out that hybrid work models are shifting business travel patterns. Many workers that travel seem to have plenty of disposable income. And, at least recently, they are using some of that income for travel. The hybrid work models mean that they are not tethered to their desks. But, not all companies are seeing profits continue like the airlines are. Retailers and tech companies are locked in a pitched battle for consumer spending this holiday season. Average and middle-income households are facing rising costs for a number of essential items. Housing, especially rents, groceries, and, of course, gasoline. Big retailers, with the exception of Home Depot and Lowe's, are feeling the heat. Target and Walmart had decidedly downbeat Q3 earnings calls, especially Target. Consumers are spending on travel because many were unable to take trips during the pandemic, said Walmart CEO Doug McMillon. They're spending that money to do that because it's a priority, Kirby also noted. So clearly, we are in a mixed economy in which all sectors and companies are having uneven fortunes. Air travel is obviously hanging in there. We are still in the phase of pent-up demand. And, while many companies have forced workers back to the office, it appears that some employees will continue to be allowed to work from anywhere, at least some of the time. If you follow this channel, you know that there is a huge wave of layoffs in the United States. But not all companies, sectors, industries, and income levels are equally affected. Employees of big tech companies are feeling most of the pain of job cuts. That is because many tech companies are at least partially supported by advertising. And, if you follow this channel, you already know the financial economic narrative of these times. Inflation is raging in most countries. Central banks around the world are aggressively raising interest rates in order to fight inflation. So, people who borrow money for anything are having to spend more of their budget on interest. Incomes are not rising as fast as interest are keeping up with inflation. So, consumer budgets are getting squeezed and reapportioned. Consumer discretionary spending is getting squeezed out. Corporate marketers are cutting advertising budgets because they are sensing that consumers have less discretionary income to spend. And advertising is the lifeblood of many big tech companies. As a result, big tech companies have announced layoffs. Those layoffs are anywhere from a few hundred employees to a 50% layoff at Twitter. Declines in consumer spending are hurting retailers. And that is also hurting the shipping industry. If you follow this channel, you have heard us report on the decline in shipping, especially from China. The volume of shipping containers from China to the US fell 21% in the past 3 months alone. Sailings of container ships are being canceled. And ocean carriers are experiencing export rollovers. Logistics managers in the US are preparing for delays in the delivery of goods from China. Carriers have been announcing more blank sailings and suspending services. They are trying to balance supply with demand by executing on an active capacity management strategy. Analysts are expecting shipping container volumes to decline another 2.5%. And that collides with a planned 5 to 6% increase in shipping capacity in 2023. So that means that freight rates will likely head lower in 2023. Ports on the west coast of the United States appear to be taking the biggest hit. Back in June, J.P. Morgan CEO Jamie Dimon warned about a coming economic hurricane. That it may be less intense than Dimon originally feared, according to a new report from J.P. Morgan Chase. Investors somehow expected that positive inflation news would cause the Federal Reserve to rethink its course. But Federal Reserve leaders doubled down on their position that more interest rate hikes would be needed. They are predicting a 50 basis point increase in December. And they are also predicting 2 additional 25 basis point increases in February and March. That would result in a federal funds rate near 5% by May. Many economists think that amount of financial tightening would push the U.S. economy into recession. But at the same time, the U.S. economy has stayed somewhat resilient. Job growth has stayed fairly durable despite the fast rising interest rates. And consumers continue to spend money. But consumers are now focusing on needs versus discretionary items. Keep in mind that even in a mild recession scenario would weaken the job market. And, in that case, the U.S. would shed over 1 million jobs by the middle of 2024. Federal Reserve Chairman Jerome Powell said that declining job growth is required to bring down inflation. But that is what it takes to recalibrate the economy after several years of pandemic-related disruptions. As far as these economists are concerned, the U.S. economy will enter a recession later next year. And that will cause job losses. Investors and CEOs have been preparing for a recession since the Fed started hiking rates. That fact alone should change the nature of the slowdown, they added. Some say the painful end of get-rich-quick thinking may be good for the economy. Speculators hoping to make a killing as cryptocurrencies got slammed this year. Cryptocurrency values briefly rebounded from this year's plunge in valuations. But then one of the most trusted exchanges for crypto trading, FTX, filed for bankruptcy. Old-school financiers look askance at inexperienced crypto investors who they say should have known better. This year, there are new signs of a catastrophic decline in speculative investments in general. And this is part of a general trend that goes far beyond Bitcoin and other cryptocurrencies. A lot of so-called investments, like house prices and tech company valuations, look completely overvalued. That goes for so-called fintech innovations, including cryptocurrency, as well. These risk assets recently seem to be shooting for the moon. But they are now coming back down to earth. Many investors are getting burned as soaring speculative investments crater. Not just that, many people are saying that this trend will actually benefit the economy. Recent years of speculative investments have encouraged get-rich-quick speculation. Rising interest rates mean a return to the old-fashioned kind of investments. Real-world investments that use money and workers more efficiently to create real economic value. Only when the tide goes out do you know who's been swimming naked, said Warren Buffett, a longtime advocate of slow growth. The U.S. is teetering on the brink of recession. that inflation continues to rage. And the Federal Reserve is aggressively raising interest rates to fight inflation. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.